So, welcome to another discussion. So, today we are going to discuss about market divergences. So, we have heard about indicator divergence, especially the momentum indicators like RSI or even stochastics or even MACD. So those are divergences. We basically take advantage of those divergences and take trade. Mostly in planned trade in the opposite direction. So what happens if the market is going in certain direction, an indicator is actually going in kind of in a different direction. So we then find out the entry point, and we take generally those pullback trades or maybe reversal trades, right? So here we are not going to discuss indicator divergences. We are going to discuss intermarket divergences. So what is intermarket divergences? Intermarket divergences basically, suppose there is an index right now. Here it's Nifty, right? So this index Nifty is consist of different stocks. Okay, so in those stocks we all that also we consist of different sectors. So the constituents of different sector means, suppose there are bankings, IT, those consumer goods, those kind of sectors, right? So in an index, you will find there are certain sectors which has the highest weightage. Right, in Nifty, the highest weightage is financial sector, the banking and all, right? So that is Bank Nifty. It has the highest weightage in the Nifty, so almost 60% plus weightage in Nifty. So generally, if 60% weightage is given to a certain sector, if that sector performs well, obviously the index will perform well. If that sector performs worse, the index will perform worst, right? Because that is simple math, right? So here in normal intraday trading also, we can, like in investment, we can use it very well. Even in intraday trading we can use it very well. How? We're just going to discuss here, right? So today morning you can see my market opens gap up, similar with Bank Nifty as well, right? Market gap up. After that, you can see the Nifty has consolidated here, right? You can clearly see Nifty has consolidated in this zone, right? See, right? But you can clearly see Bank Nifty from the morning only. It has continuously breaking lower lows and making lower lows. So the falling has started continuously. Whereas Nifty, you can see, has hold. So this is called divergences, right? So for Nifty, Bank Nifty is a leading indicator. Why? Because as I told you, this has the highest weightage, around 60% plus, right? So if the weightage is highest, so generally if this goes down, the higher chances that this also will go down, right? Because it has highest weightage, right? So you can clearly see here, as a trader, you might find opportunity that what to do here, right? There is a gap up, it might consolidate and start moving up again. So how can you predict this going, this will break on the downside? Here is the example. As you can clearly see, this candle actually break this consolidation, right? It's around 9:55. Where is 9:55? Here, see, this is 9:55 candle. So you can see all previous candle, it was continuously making lower lows, whereas this is not making lower, this is just holding here, right? So this gives you indication that market will go down. So as a trader, this is your golden opportunity, right? If Bank Nifty has started continuously going down, it is making continuous lower low. So this was a smart trader. When there is a pullback, suppose in this candle, right, you have a very good chance to enter, and very small stop loss just above this high, very small stop loss, you could have gained so much, right? So as a trader, when we trade, there are technicals as well, and this is divergence is also a strategy which we can use it very well, and we can make very good profit from here. So this would have been a no-brainer trade, and before this actually breakdown, we could have entered very quickly, right? So what happened, if we enter quickly, if we can anticipate a move properly, what happened, we enter in a move quickly. So what happened when the moves actually started coming, because after this breakdown, all these breakdown traders will enter. So what happened after entering only, you will get very decent profit, very quickly. Why? Because people generally, all traders generally enter in these candles, right? They will enter, but you have already onboarded the bus, so you just sit back and enjoy, and with a small stop loss. So that's the way. If we can actually combine technicals with this kind of strategies, we'll find that our edge in the market will be very higher. And not only will be able to take very good trades, in terms of accuracy will also, accuracy will also increase. And second thing, the profit ratio, right? Because you'll have a smaller stop loss because you have entered early. So the risk to reward ratio will be higher. So as a profitable trader, you need two things only, right? One is risk to reward ratio, which should be higher, right? And second thing is, you need is the winning ratios. So if your winning ratio also goes up, and risk to reward also goes up, so you generally will make a lot of money, probably as a similar kind of trader who has almost taken the same trades, but still you will make very good money. That is the edge. Why? Because you have entered early, and you have actually, not only based on technicals, you have applied some market strategies, which actually smart money. You have to understand, these are all done by smart money. So the smart money stresses, we have to find out what smart money is doing. If we move on the direction of the smart money, then we will understand, we will also make very good money. Why? Because market is run by smart money, not like traders like us. So the best way to follow smart money is this. Because see, as normal trader, we might trade individual stock without seeing anything, only based on this individual, individual technical analysis on that particular stock. But smart money, they don't do a trade like that. They have a different philosophy about market. They generally use a top down approach. So they don't just sell a stock or buy a stock like randomly. They understand the macros first, right? Then they understand what kind of sectors will do well in those kind of macros and scenarios, right? Then on that, sector, they will enter and they will find the stock. So they are very top down. They are doing a top down approach. So we'll also kind of follow this, trading or investment strategy well. We follow the top down approach. So this is a fantastic strategy which we can use, right, to make good money. So similarly, if you see for indexes, for stock trading as well, suppose, let's say BPCL. Okay, so how we can apply this in BPCL? So BPCL is a stock, right, and it's under this Nifty, right? So suppose I have taken a, so selling trade in BPCL. So it was like market is going down, so probably the higher chances that, because it's under the index, so it will also go down. Now see here, there is a pullback, right, and it's going up. So you might find, oh, this might be a decent pullback, and this might, because any pullback can turn into a reversal, right? So it might reverse. But you can see this index, right? Index here is just consolidating, it is not making highs, right? So the higher chances that this will also go down. And when this goes down, if no matter how the, uh, how good the stock condition is right now, suppose BPCL is in a very good condition, but because the market is going down, this has to bound to follow on the downside, right? If the stock is very powerful in certain time, that it might hold. Or sometimes if there is a very good news in that stock, then it might it might go opposite to the direction of the index. But those are very, very less time. Okay, this it will generally follow the trend of the market. So here market is going down, you can see also BPCL going down. So this way we can actually use this strategy, and make very very good money, and we can actually make decisions sometimes in exit. So suppose I sell a stock, or I bought a stock, and it is continuously going down, or it's continuously going up. So if there is a pullback, whether the pullback will sustain or not, I can find out through the index as well. So if the index is trending in a particular direction, and if you see the trend is going to follow, then you can clearly know that this there is a high chance. Yes, we will follow individual technicals as well, but this actually gives a very good indication. So what will happen, because there is a pullback, and you can see this pullback will not sustain. So there is high probability, if you see any further weakness, then you can add more opportunity, you can add more sell quantities, more quantities here as well. So you have entered in somewhere here, you are getting profit, you can enter more. Suppose you sell more, quantities, so here you'll get more money here, because this actually helps you to identify that this will eventually go down. So this way, we intermarket divergences we can use to identify where to enter, where to exit, and actually use those strategy for our benefit, and to make most of it, right? So in like this, we'll definitely use or discuss different strategies in our future video as well, right? So here also you can clearly see Nifty started falling, right? But Bank Nifty, you can see clearly, it is now from here to here, this continuously making low Nifty, but Bank Nifty has not made any low, right? So there is certain thing we have to understand, that probably there is a high chance that either this will break down. So if this breaks down, so the Nifty will follow. But if it is not breaking, that is holding, so by probably you will see Nifty also will turn from here, right? So we'll see it in other different videos as well. So I hope you like the video. If you like the video, always mention in comment section that you're liking it, so I'll make some more videos on that and different topics, right? Thank you.